Thanks very much, Benita. Just one correction from my side, or amendment, is we'll probably break for tea at about 10:45 rather than 10 o'clock. But I'd like to welcome everyone here to this tax update. We are, and especially the South African Institute of Tax Professionals that are also going to be participating. We're going to focus on the two bills that we've got for 2014, the Taxation Laws Amendment Bill and the Tax Administration Laws Amendment Bill. So those are the two bits of legislation that this is based around. We're not going to go through every single amendment, you'll be pleased to know. I've got a lot of slides here. There are about 107 slides, okay, but we're not going to go through every one. My thinking was that I'd prepare fairly wordy slides so that they, deliberately so that later on you could just refer to them. The slides would be sort of self-explanatory without having to refer to supplementary materials. I've been guided in what is important by the explanatory memorandum to the bill, and I've added some other things that I thought were particularly important as well to that. I've taken quite a few examples from the explanatory memorandum and I've adapted them where necessary. And it has been necessary because sometimes the legislation that we've got in draft form hasn't been the same as what is reflected in the explanatory memorandum. We've had now the second version of the bill, the Taxation Laws Amendment Bill, that has been introduced into Parliament, and it's probably going to be passed by Parliament during the course of this year. The question, of course, is when it gets signed into effect by the State President, and it might well be that that is also before the end of the year. I don't think we're going to see any more changes to that bill from the final version that has been released and sort of published on the SARS website. These slides will be emailed to you later on today, so you will get a copy of the slides. We should be done here by 11:15 or so with the tax update session. All right, I think without any further ado, let me get the show on the road. The first sort of dramatic announcement that I want to deal with is this delay to the retirement reform proposals. So what was proposed and that's been delayed is, for instance, where all contributions by an employer on behalf of an employee are going to be taxed as fringe benefits in the hands of the employee. That's been put on hold, as well as the compulsory annuitization of provident funds, where in future you'd only be able to take 1/3 of the fund value as a lump sum. The rest you'd have to annuitize over your life. So that's been delayed. The interesting thing about that was that the press release said that it would be put off till 1 March 2017. But if you look at the legislation, it's actually been drafted as the 1 March 2016 that it's been delayed to. So it's quite interesting that there's that discrepancy. And maybe the idea being that more time would be bought to possibly renegotiate the implementation date of these reforms. But what this also then relates to and affects is that the contributions by an employer to a defined benefit fund are also going to be taxed as fringe benefits. That, of course, has also been delayed along with the other proposals. So paragraph 12D of the 7th schedule that values those contributions has been substituted, but also it's been delayed, the implementation of that. I'm not going to go into the detail behind that. What hasn't been put off, and I think this is a positive change, is the change to the definition of retirement date. Because what happens at present is if the rules of your fund state that you retire at the age of 55, then you tax retire at the age of 55 even if you carry on working for that employer. So in future the idea is that that's not going to happen. as long as the rules of the fund allow you to retire at a later date than the minimum age stipulated, you're going to be able to continue to contribute, and you won't be forced to tax retire at that minimum age. And one of the difficulties with the current situation where you tax retire at, say, 55, is that often people don't realize that they've reached that retirement age stipulated in the rules. So the fund is therefore not in position to get the, what it has to do is to get an election from the member of how much they're going to take as a lump sum and how much they're going to take as a lifetime annuity. And often they're not in the position to do that because no one kind of realized that the person reached that age. So it's also going to solve that problem. So I think that's quite a welcome development, and this change comes into effect 1 March 2015. But I must add, it's if the rules of the fund allow you to do that. But the tax rules have been amended to cater for it if the rules of the fund allow one to retire later. With employer-provided rental accommodation, so this is where an employer provides an employee with accommodation as a fringe benefit. The problem experienced at the moment is that, especially in circumstances where that accommodation is rented from a third party, that the way the fringe benefit works in the 7th schedule is that there's a formula there based on the person's remuneration, and you take the higher of the formula amount and the cost to the employer of providing that accommodation, the greater of those two. And often the formula gives a higher result than the actual cost to the employer. And Para 9 then says in those circumstances the employer can ask for SARS, apply for a directive to have the formula amount in effect lowered to a reasonable amount. So there's this sort of bottleneck, admin bottleneck that's created applying for these directives. So the change here is that if it's rented from an independent third party, an unconnected person in relation to the employer, that one will in fact then use the lower of the formula and the cost to the employer. So hopefully that situation will change. The other interesting thing here is that let's say that you get 2 employees sharing the accommodation. They stay in the same house or flat or whatever it is. Each of them is taxed the same way with no reduction. And so they said that this is also going to be looked at in future, that possibly there'd be an allowance made where the accommodation is shared. But that's not for now. That's not in these amendments here. With the company car fringe benefit, the present system is seen as unfair in the sense that if you work for a car manufacturer or for a person that's in the motor trade, your employer can often obtain that vehicle at a discounted price to what other employers would obtain the same vehicle for. And the way that the determined value works is that you start off with the cost of the vehicle to the employer. So in future that's going to change, and the idea is that the retail market value will be used in all cases. The retail market value is going to be something that is given by way of notice. So it's going to be determined by regulation, and the idea is to use the list price for new vehicles and to look to the insurance industry if it's a second-hand vehicle. But the idea is that there's going to be this list of prices, and that's what people are going to have to use for the determined value in future. But just note the effective date of this provision. It's not going to apply to pre-existing company cars. If you look there, the effective date is vehicles acquired by the employer, or in cases where the employer manufactures the vehicle, then manufactured on or after 1 March 2015. So it's only to vehicles that become company cars in effect after that date. Then quite a positive change, although I think that the limits here are low, and that's been criticized with this proposal from the start, is that there are going to be these funds set up where one's going to be able to invest these amounts. They're quite small, as you can see, 30,000 Rand per annum. up to a lifetime ceiling of 500,000 Rand overall in tax-free savings vehicles. And everyone's waited with bated breath as to exactly what type of investments would be allowed to be in this basket of funds. The good news is that draft regulations were published last week, I think it was, setting out the type of entities that are going to be able to issue and administer these types of funds. It is the usual suspects, so we've got the government, we've got banks, we've got LISPs, we've got collective investment schemes in securities, in other words, unit trusts. They're going to be able to issue them as well, and the long-term insurance industry. And also what type of products are going to be able to be included has also been the subject of a draft regulation. And there isn't, if you look at that draft regulation, it's not totally prescriptive in saying, well, it's these, they can pick from this list type of thing, but it's more says what can't be included. Like, for instance, it says that they can't use derivatives except if it's for hedging purposes. And the idea seems to be to make them less risky than might sort of otherwise be the case. Another thing that's been controversial is to say that they can't charge performance-related management fees. So these products are not going to be the subject of performance-related management fees, which has come in for quite a bit of criticism. But I think the idea there is that you don't want a fund manager to go in a particular year sort of hell for leather and take a very risky basket of securities, for instance, to try and maximize the return. So they're trying to sort of protect the investors to a certain extent. But the idea is that any return within the fund itself, as well as if you withdraw your money, you're not going to be taxed on it at all. So a withdrawal followed by a return to such investment, as well as you can transfer between one type of tax-free savings product and another, those won't count towards those annual contribution limits. There's a stiff penalty, though, if you contribute in excess of those limits. 40% of the amount that you contribute in excess is going to be taxed in your hands, taxable income. On death of a taxpayer, you're not going to be able to leave them to someone else and have them add that amount to their own limit. Their limit stays as what it is, the 500,000 and the 30,000 per annum. They're not going to take away the Section 10(1)(I) interest exemption for natural persons, the 22,800 per annum, for instance, if you're under 65. That's going to, however, remain constant. It's not going to go up with inflation. And the idea is to bring these products in 1 March 2015. There's widespread concern that the industry is not going to be ready to implement it on that date, but at least the tax proposals will be ready on that date. The one nice thing about this is as well that although the 30,000, 500,000 are quite low, obviously it'll take a long time to get to the 500,000 even if you contribute the maximum every year. But it applies to individuals regardless of their age. So for instance, if you've got a family set up, you could donate money to your minor children and have them contribute in their own names to these investment products. So I thought let's just look at this example of how this could work in that type of situation, where let's say we've got a father donating 30,000 to his spouse as well as each of their 2 minor children for them to make contributions to these products. And let's say they do that, 120,000, the 4 of them, between the 4 of them in the year. And then in the next year of assessment, those 2 bullets happen in the following year, that interest of 1,000, dividends of 2,000 Rand per person accrue. Those amounts are then rolled up and reinvested. And subsequent to those accruals, one child disposes of his tax-free investment for 36,000. And then let's say that in that second year, the father once again makes these contributions of 30,000, to those, donates it to the spouse and the 2 children and contributes himself in that year. So, firstly, from the point of view of donations tax, the donation to the spouse is exempt anyway from donations tax. Donations to other persons are allowed up to 100,000 Rand per annum, so those in this example would all be exempt from donations tax. And the interesting thing from an income tax point of view is that if you look at the wording of section 7.3, it says that income that results from a donation made to a minor child reverts back to the parent. And income is gross income less exempt income. So it seems from that wording that you first of all take the exemption off in the child's hands before then attributing the zero to the father. So that's in effect what seems to happen here. So in fact the father isn't taxed on that income. The same result ensues in terms of the 8th schedule, para 69, will have the same effect, that the capital gain will end up not being taxed in the father's hands. And the question here is whether the father then contributed in excess of the 30,000 Rand, or whether in fact, in this example, whether all of them contributed in excess of that in the second year, because remember that there were those reinvested amounts which were also then contributions. But the wording says that amounts that are reinvested shall not be taken into account in determining whether a person contributed in excess of the limits. Now, shall not be taken into account to me is a little bit ambiguous, because it could mean that, well, you just ignore those and you're still stuck with your absolute 30,000 that you can contribute. Or it might also mean shall not be taken into account that, well, you know, you can use those amounts in addition to your 30,000 and regard them as tax-free. It seems that the intention is that those amounts should be allowed to be contributed without contravening the 40% amount, because if you look further down in section 12 capital T, it uses the same wording where you have a transfer between these products within a year. And I think quite, you know, one would think that the intention then is that you should be allowed to transfer without contravening your 30,000. So I think that should all be fine. With respect to key person insurance, it's a fairly minor change here, but effectively what it says is that if you're claiming a deduction for a risk-only policy, you're not allowed to continue claiming that deduction for those premiums if you cede that policy to a creditor as security for your debts. That's effectively what it says. Restraint of trade receipts. At the moment, the way that the gross income definition works, paragraph CA, is that if you've got a sole proprietor, let's say a car dealer, that's trading in his own name, and sells that car dealership, and there's a restraint of trade in terms of that agreement, that car dealer is subject to a gross income inclusion for that restraint of trade, even though it's got nothing to do with services rendered to an employer. Whereas if the car dealer had operated in a company or a trust, that wouldn't have been the result. It would have been regarded as a capital receipt in that person's hands in normal circumstances. So the idea here is that there's an amendment that's going to be put through to sort of say that if an individual receives a restraint of trade, as long as it related to future or past services, the amount is gross income, but it's not going to be gross income necessarily in all the other cases. Before I go on to business, does anyone have any questions on what I've covered up to now? All right, also please feel free during the break if you do think of questions and you'd like to ask. I'm here, David is also here from the Joburg office. If you'd like to ask us questions, please feel free. Just moving on to business. The third-party backed share provisions, I'm not going to go into the whole background of what a third-party backed share is. I'm sure that if you're in the audience and you've got these third-party backed shares, then you'll be acquainted with what they are. So let's just have a look quickly at what the amendments are. Firstly, Exploration companies are going to be added to the definition of operating company, which is quite a positive result. So you'll be able to escape potentially from this reclassification if you're an exploration company. The second one is quite a technical change, and I just thought let's look at an example. If we've got a preference share, and I've called it Pref 2, that is issued to acquire or redeem any other preference share that was issued for a qualifying purpose, enforcement rights or obligations enforceable against the issue of Pref 2 must be ignored, and arguably that's not in the legislation at the moment, so that's been clarified. I think that always was the intention, as I understand it. It's now been made explicit. And then the third one is to deal with so-called asset-based prefs. Say a company 1, issues prefs to acquire equity shares in an operating company. Enforcement rights or obligations exercisable against the shareholders of Company 1 will be ignored regardless of their percentage holding in Company 1. Present legislation says they must have a 20% holding or more to disregard it, but provided that two conditions are met, which are there on the slide. And this change has been backdated. Then Section 23M is an important amendment. It affects quite a lot of companies, so I'm going to go through these changes. There are quite a lot of them. This section has come in for a lot of criticism since it was first introduced into the Act, but the point is that it is coming in 1 January 2015. And basically what it says is that if you've got a South African debtor that is paying interest to a person that is exempt from the interest totally. So in other words, it says not subject to South African tax, meaning not staying that the amount is exempt from normal tax, or that it's subject to a double tax treaty that reduces the rate to 0. So they're not subject to tax on the other side when they receive the interest. And those parties are in what's called a controlling relationship, which up to now has meant connected person relationship. That you'd be limited to the deduction that you could get for the interest paid to such a person. And there's a formula in Section 23M that governs that amount of interest that could be deducted. So it's seen that this could further discourage foreign investment into South Africa, because bear in mind that this applies in addition to transfer pricing, which then becomes a second issue that one's got to worry about. So the first thing is, it's possible to do a corporate reorganization transaction using the corporate rules, where Section 23N, because there's a formula there that also limits interest deduction, which is similar to the 23M formula, and M both apply. In other words, where you get the funding to do that reorganization transaction from, let's say, a foreign holding company. And in those circumstances, the order in which they apply has been reversed. It's now been made clear that you apply the N formula before the M formula. A taxpayer-friendly amendment has been made that's cut down the breadth of what constitutes this controlling relationship. It's no longer connected person. It's now got to be 50% or more voting rights or equity participation before you have this controlling relationship. And just bear in mind that could work in either direction. So it's not to say that the creditor must be the one holding shares in the debtor. It could be the debtor holding shares in the creditor, but there's got to be a 50% participation. The definition of debtor has been widened a bit, where you could have a situation where you've got the interest that's payable between two non-residents, for instance. But the first non-resident has got a branch in South Africa, a permanent establishment, and that non-resident, because the branch is part of the legal entity, it's one and the same, and that then is a non-resident paying to another non-resident that's in a controlling relationship. Guarantees given by a person in a controlling relationship are not going to be sufficient. There's actually got to be a flow of funds before this will be triggered. At present, the way it's worded is that a guarantee is sufficient. So that's fortunately going to change. So you could have a non-resident holding company, for instance, giving a guarantee to a foreign bank, and the foreign bank then makes the loan. to the South African subsidiary. At present, that would trigger the section, so that's going to be changed. Assessed losses are not going to be taken into account in future in determining your formula. That's also taxpayer friendly because it would have the effect of deflating your taxable income. At present, the way it's worded, you use 40% of the adjusted taxable income. That's your limit. The 40% is a static figure, except if the repo rate goes above 10, then it goes up. It's now going to change on an annual basis depending on the average repo rate for the year. And this is how it's going to change on an annual basis. I just set the formula out there. So A is the percentage to be determined, B is the number 40, C is average repo rate for the year plus 400 points, and D is 10, and they've capped the absolute amount at 60. So if we just look at an example for that, let's say the average repo rate is 8%. So under the current dispensation, you'd stick at 10, okay, because the average repo rate's not above 10. So the formula that you'd apply would now give you 40% times the adjusted taxable income amount. Under the proposal, what you apply to the adjusted taxable income is now going to be this. 40 times 12 over 10, because it's the average repo rate of 8 plus 400 basis points. It gives you 12 over 10. Gives you 48% times the adjusted taxable income. If the average repo rate goes up to 12, then the formula gets capped at 60. And the effective date of this is 1 Jan 2015, interest incurred on or after that date. There's a bit of a glitch. I don't think it was intended. But basically the withholding tax on interest has now been put off to 1 March 2015. But this section is coming in on 1 January 2015. So we're going to have a 2-month period, in theory, where you've now got to apply this limit for those 2 months before, let's say, the withholding tax kicks in and that non-resident is subject to tax on the interest. So that's a problem that's been highlighted. Hopefully it's going to be retrospectively amended, but I think as the bill is at the moment, it's probably going to go through in its current form. Then the section, sorry, yes.
Is this in conjunction with thin capitalization?
Yes, you've got to apply thin capitalization as well as this, yeah. Section 23N, that formula relates to if you're doing reorganization or acquisition transactions using corporate rules and you're using interest to fund those transactions, there's a formula very similar to the 23M formula. The amendments are, in some respect, some of these amendments are similar to or the same as the 23M ones that we've just looked at, where, for instance, assessed losses won't anymore deflate the amount of adjusted taxable income that you use in the formula. Another amendment is that you're now going to be able to choose the highest out of 3 years of assessments adjusted taxable incomes for your formula. The year of assessment in which you actually did the reorganization transaction, the year immediately before that, or the current year of assessment, in respect of which you're looking to deduct the interest. You can pick the highest of those 3. The idea, I think, being that the year in which you do the transaction is a baseline. So you're never going to have to be forced to go lower than that with your adjusted taxable income. But then it was felt that because that can be quite a disruptive year in which you actually do the reorganization, that it might not be reflective of the normal sort of level of taxable income. So it's been allowed now to use the year immediately before that year. And then the same adjustments to the 40%, that's not going to be static anymore, exactly the same adjustments as we looked at previously to the 23M formula. And this is coming in 1 Jan, years of assessment commencing on or after that date. At present, if you convert one class of shares into another, the contributed tax capital of the first class is simply lost, because the Act doesn't cater for a transfer of contributed tax capital from the old class to the new class. And that is now being rectified. So the idea being that you work out the number of shares that you're converting, and you take the attributable CTC for that number you're converting, and you put them into the new class of shares. So I thought let's just look at an example of how that works. Let's say that you've got 1,500 A-class shares and they've got a CTC of 15,000. 2/3 of those shares are converted into 500 B-class shares as a result of election or some other event. And prior to the conversion, let's say that there are 200 B-class shares in issue with a CTC of 200 Rand. The result then is that you now going to work out the amount of the CTC that is attributable to the shares you're converting. So you take 2/3 of your current CTC, you take them out of the class you're converting from, and you put them into the class that you're converting to. So after the transfer, the 500 Class A shares of CTC of the 5,000 that remains, and the 700 Class B shares of CTC of 10,200. There are quite a few changes to the taxation of long-term insurers, I think, and I'm not going to plow through all of them. There are quite a number of slides here on it. But just to say that probably the most significant change is that we're no longer going to have the so-called four-fund approach to the taxation of long-term insurers. There's a fifth fund that's been introduced to cater for the risk policy business of the long-term insurers. At one time it was proposed that the risk policy business would be taxed in the corporate fund. That proposal has now been changed to actually a brand new fifth fund for that type of business. This year's amendments, quite a few of them wouldn't have made the news headlines in any of the newspapers anywhere in the world, and I think this is one of the examples that made it onto what was given in the explanatory memorandum as the more important amendments. All this is doing is saying that when it comes to the taxation of real estate investment trusts, or REITs in other words, that if you've got a foreign company, foreign property company, that one's going to be able to produce financial statements in compliance with IFRS rather than at present with the South African Companies Act. And that change has been backdated. With the taxation of banks and brokers, the change that's been made here is that an interest in a partnership, which is a financial asset to a bank or broker and is now subject to this new mark-to-market basis of taxation under IFRS, that will be excluded from the mark-to-market system, because the idea apparently wasn't to tax interests in partnerships as the market value of those interests fluctuate every year, not to include those amounts in taxable income. So the normal taxation principles that apply to the taxation of partnerships in the Act would rather apply. Looking at incentives, allowances for telephone lines or cables used for electronic transmissions, that wear and tear period is going down from 20 years under Section 12D to 15 years. And in addition to that, used assets are in future going to qualify for that write-off period. The Section 11F lease period, where there's an indefeasible right of use for undersea cables, that period, though, has been left at 20 years. There's got to be an indefeasible right of use for at least 20 years. That hasn't been moved down to 15 years. And this isn't backdated. It applies to assets that are acquired on or after the 1st of April 2015. So only assets acquired after that date, not pre-existing assets owned. They won't benefit from this new dispensation. With the R&D incentive, Section 11D, there are 5 changes proposed. The first one is with clinical trials, where although the Act was amended last year to try and cater for including clinical trials into the R&D incentive, one of the problems was that the definition of research and development itself wasn't sufficiently changed to allow clinical trials to qualify. And so the idea now is that a new paragraph specifically added to the definition of R&D to allow clinical trials to qualify, and it refers to clinical trials conforming to such requirements as prescribed by regulations to be made by the Minister. And we've had draft regulations that were issued for public comment earlier in the year. Those haven't yet been finalized. But this change then has been backdated to allow clinical trials to qualify. Similar thing with the production of generic medicines, research into that. Technical term for generic medicines is multi-source pharmaceutical products, and there it's probably even clearer that the definition of research and development doesn't cater for this at the moment, because it's got to be innovative to meet the requirement for it to be research and development. And obviously with the production of a generic, the outcome is already known. So a very similar thing, added a paragraph to the definition of R&D. Once again, requirements to be prescribed by the Minister. We've had draft regulations, but they haven't been finalized yet. The third change, functional designs. Functional designs are going to have to now specifically include an innovation requirement. At the moment, one can kind of get by with it not advancing any scientific or making an advance in any scientific or technological sense, it would appear. So that is being changed. Then in a group situation where you've got research and development happening within the group, often you have, let's say, Company A that is funding the R&D activities that are actually carried on in Company B. So Company B does the R&D, Company A funds it. There's a glitch in the Act at the moment where if you're in that situation, then provided that Company B doesn't itself claim for the same expenditure, Company A is only allowed to claim 50% of the R&D spend. And it was intended that it should be the same as anyone else, 150% of the current expenditure. So that in a group situation, that glitch is going to be rectified. And then if anyone is doing R&D activities in a form other than a company, it's best that they change, because the 150% deduction in future is only going to apply to R&D undertaken in a company and not to other taxpayers. Apparently there were quite a few people who were doing research into tax and so forth and writing it off as R&D expenditure. Public-private partnerships. Often the government enters into arrangements with the private sector, whereby the private sector puts up buildings on government-owned land. And quite often the private sector then gets the use of that building after it's put up. And that's termed a public-private partnership. And the thing here is that because the private party is putting up those buildings on land that doesn't belong to it, they are therefore not the owner of those improvements, and therefore they can't claim the wear and tear allowances on those buildings. So we've got Section 12N that currently allows the taxpayer to claim those allowances as if they'd been the owner of those buildings or improvements that are put up. But with 12N, the private party has got to have the right of use of that building, or the right of occupation of that building. So often that isn't the case in practice, because often what happens is that the government itself gets the use of the building. Private party puts up the building and then the government moves in, not the private party. So it's now proposed that a new Section 12NA be put in, whereby the same sort of result is achieved under 12N, whereby if it's a public-private partnership, and the government gets the right of use, that the private party is still going to be regarded as the effectively able to claim those allowances. Spread over 25 years or the term of the Triple P arrangement. Doesn't apply to persons carrying on banking, financial services or insurance business. They are excluded from claiming under 12NA. There's also an anti-double dipping rule where the idea being that if you get a grant to fund that building and that grant is exempt in your hands, you mustn't then be able to claim capital allowances to the extent that you use that grant to fund the improvements that you put up. So I thought let's just look at this example which was taken from the explanatory memorandum. We've got the government enters into an agreement with the private party, and the private party is responsible for the financing, design, constructing, operating and maintaining of a new building that will house a national department. So it's note the government moving in, it's not 12N. We need a new section for the private party to be able to get an allowance. The private party is responsible for sourcing debt and equity financing. Government pays a capital contribution to reduce future monthly unitary payments. Unitary payments are ongoing regular payments that are made by the government to a private party in terms of one of these arrangements to help to cover costs. And let's say that the capital contribution is 2 billion. They also get monthly unitary payments totaling 18 billion over the term of the contract from the government. So the total value of this contract is 20 billion. So the result is that there's an exemption, section 10(1)ZL says that to the extent to which you use one of these government sources of funding to finance improvements in terms of a Triple P arrangement, that the amount is exempt in your hands. To the extent that you actually apply that amount to the cost of the improvements or the building, it's exempt. So therefore that exemption applies if they spent at least 2 billion on the building. And the idea is that your capital allowance in terms of 12N or 12NA now must be reduced. You can't, if the building, let's say, cost you 3 billion, you've got to reduce the 3 billion by the 2 billion exempt funding that you got, and you can only claim based on 1 billion of that funding, of the amount that you've spent in terms of your allowance over 25 years, or the term of the Triple P arrangement, whichever is less. And then because the unitary payments are not exempt, there's no problem. You can then claim your 11A deductions based on those amounts received from the state. So this has been backdated to 1 January 2013. I won't spend any time with oil and gas. We had quite a few people from this industry attend the Joburg presentation, unless we've got someone here in the audience. But anyway, the idea being that the fiscal stability rights will be able to be transferred to all the parties in a joint venture arrangement. Industrial policy projects, this is quite a nice incentive, because if you conduct a manufacturing project that is approved by the Department of Trade and Industry and it qualifies, you can then claim additional allowances over and above the allowances in the Act for that project. For instance, you can claim up to an extra 100% of the cost of manufacturing assets that you use in that project if you qualify, and you can also claim up to 36,000 Rand per employee for a training allowance. Issues here, firstly, the current form of the provision means that if you put up immovable plant and machinery on land that you don't own, because you're not the owner, technically you can't claim these allowances. So that's going to be addressed. References to the industrial development zones have now been changed to special economic zones, because the idea is that the Special Economic Zones Act has already been gazetted. It's not yet in effect though, and from the date that it comes into effect, and after that it might take a while, but the industrial development zones are going to be converted into special economic zones. And in addition to the current IDZs, we're going to have more type of zones that qualify as special economic zones as well. And then quite significantly, in order to qualify for these projects, the asset limits that you've got to invest in, that you've got to spend to qualify, has been reduced quite significantly. So in the case of a greenfield or brand new project, the limit has gone from 200 million investment in manufacturing assets down to 50 million. That's a huge decrease to allow companies to qualify. In the case of brownfield projects, which are basically upgrades or extensions to current projects, the limit's also gone down. It's a bit more of a complicated limit, but it's also quite a significant decrease there. If you own land that you donate to the state for purposes of the state making that into a game reserve or a national park, at present you get a kind of deemed donation allowance under Section 18A. That is limited, like all your 18A allowances. 10% of taxable income is what you can claim. And the problem is seen with that it benefits the taxpayers with the highest taxable incomes, not necessarily those with the most valuable land to give to the state. So instead of that dispensation where it's limited to 10% of taxable income, it's now going to go to a straight line 4% per annum for everyone that does that. So it's not going to depend on the level of your taxable income in that entity as to how much deduction you can get. I've got an example here, but I'm not going to work through that one. Then looking at small business corporations and the turnover tax, there were some controversial amendments that were proposed in the first draft. I'm quite happy to say that those have been taken away in the final version, largely arising out of the report of the Davis Committee earlier in the year. This proposal was that instead of the current graduated band or rate system that we've got for 12E small business corporations, that would be scrapped, that differentiated band system, and everyone would now get a 15,000 tax compliance rebate. So if you had no taxable income, for instance, after all your deductions, you'd be able to get this 15,000 handout from SARS physically paid to you as long as you're tax compliant. The problem with the proposal is that it encourages small business corporations to remain small, because your 15,000 is a flat amount and it's more significant the smaller you actually are. When you move up to the higher bands of taxable income, then it's not as meaningful. So that's one of the problems. The second is that it's supposed to be there to compensate these small business corporations for the costs of compliance, of tax compliance. But the costs of tax compliance in most cases outweigh that quite significantly, the 15,000. So anyway, it's now been decided to rather let the status quo remain. And they said that they're not going to take them away altogether, that idea, but more consultation with the Davis Committee and other stakeholders. Also included was that if you had gross income of less than 1 million rand per annum, you were no longer going to be allowed to be a Section 12E small business corporation. You would have to move on to the turnover tax or stick with the normal tax system that applies to everyone else. So that proposal has also been scrapped. So even if you're under R1 million gross income, you could stay on that 12E system. Trying to popularize the turnover tax. At present, one of the problems associated with it, it's perceived, is that if one goes into the turnover tax, which is an elective system, you elect to go in there, you've got to stay in for 3 years before you're allowed to exit. So that's now being changed, where you don't have to stay in any longer for the period of 3 years. You can voluntarily come out. Sticking with the theme of small business, this is also quite a nice change. that we've got a number of entities that are set up to provide funding to small, medium and micro-sized enterprises. And specifically what they've got in mind here is enterprises that are small business corporations in terms of Section 12E, as well as turnover tax entities. So that's what we're talking about by SMMEs, 12E or turnover tax. The problem is that if you set up an entity that provides funding to the small medium enterprises, there's no specific tax advantage for you because there's no category whereby they fit into the definition of PBO, for instance. If you look at the 9th schedule qualifying activities, that's not one of them. So there's no sort of blanket exemption on donation funding that they receive. So in order to try and assist these type of entities, there's a definition of small business funding entity that's been inserted into the Act, and very similar provisions that apply to public benefit organizations are now going to be applied to these qualifying small business funding entities. Very similar. I mean, if you have a look at the criteria in Section 30, it's very similar to these criteria. They'll have to seek approval from SARS to get this exemption, but the idea is that their donation receipts and funding that they get in is not going to be subject to tax. They're going to just be subject to tax on their trading activities or their business activities. So very similar idea, as I say, to public benefit organizations. And we've got a new Section 30 capital C that sets out what the requirements are for the Commissioner to approve these type of entities. So notably here, they can't be a company. They've got to be a trust or other association of persons incorporated, formed or established in the Republic. The sole or principal object must be the provision of funding to these type of entities as defined in Section 12E and the 6th schedule. The funding must be provided for the benefit of or widely accessible to these SMMEs. Then they don't want a situation where one of these funding entities is controlled by any one funder. So they say not more than 50% of the members of the management board may be employees or directors of any entity providing funding to that small business funding entity or connected persons in relation to any employee or director. And then they also don't want a situation where one of these entities provides funding to a small business corporation that's, let's say, owned by one of the people that sit on the management board, for instance. So the funding must not be intended to directly or indirectly promote the economic self-interest of any fiduciary or employee of the entity. Dividends paid to these entities will be exempt from dividends tax as well. And then lastly, before we take a break, in the hands now of that SMME that receives that funding is going to be tax-free in the hands of that entity. So that's also good news for them. The sting in the tail, though, is that to the extent that that funding is exempt in the hands of those SMMEs, they're not allowed to claim tax deductions or allowances on expenditure made using that funding. So a similar idea that what we've got in Section 12P relating to government grants, this anti-double dipping rule. I've set out what the rules are. I'm not going to wade through all of them, but it's basically the same as the Section 12P rules, where if you get an exempt government grant, you've got to reduce base cost or reduce allowances or reduce other expenditure that you're claiming as a tax deduction. Does anyone have any questions before we take a break? Okay, thanks. I think let's have a break then, and we'll reconvene at 10 past 10. Right, welcome back, everyone. quite a taxpayer-friendly incentive that's being introduced is, or that's not being introduced, that's the wrong term, it's been in the Act for a while, but it hasn't really got up and running properly, is the venture capital company regime as outlined in Section 12J of the Act. Now, this was introduced in 2008, but very limited uptake has occurred. There only 5 applications have been received, and there are only 3 in operation at the moment. The concept here is to use this type of vehicle, the venture capital company, to pool investment funds for investment into small business and junior miners. So you've got a venture capital company, and investors subscribe for shares in the venture capital company. They get a tax deduction for the amount that they subscribe for the shares in the venture capital company. The venture capital company pools all of those funds, and then it subscribes for shares in qualifying companies that have got to meet certain criteria. They can't be bigger than a certain size. And one of the problems is that although you get the deduction when you subscribe for those shares in the venture capital company, when you sell your shares in the venture, or the venture capital company buys back those shares from you, you're subject to recoupment on that amount. So you can use it to sort of time the amount of taxable income you have in a particular year, but ultimately you don't get as big a benefit as, for instance, if it was totally tax-free or subject to CGT. So that is one thing that is going to be changed. Namely that it won't be subject to recoupment if you hold it for long enough, a period of 5 years. You've got to hold it for 5 years, then you'll just be subject to CGT on any gain that you make. Also, one of the stumbling blocks is that the size of these qualifying companies that the venture capital company must invest in is seen as too small. Okay, it's limited to assets with a book value not exceeding 20 million rand, in a junior mining company 300 million rand, which is low. So deductions will be made permanent if you hold your shares in the venture capital company for at least 5 years. The asset limits have been upped then from the 20 million rand for normal companies up to 50 million rand book value of assets, which is also still small, but it's certainly better than 20. And from 300 million to 500 million in the case of junior mining companies. And there were various other amendments made to Section 12J, which I'm not going to go through, which really relate to how to determine whether a venture capital company remains a venture capital company after it's initially been approved. But what I thought is, let's look at this example, which I also got from the EM. Investment into Section 12J VCC by an individual, let's say is 100,000 rand. They get that 100,000 rand as a tax deduction then in year 1. If they dispose of the interest in the venture capital company before the 5 years is up, they are subject to recoupment. So if they sell that investment for 250,000 rand, the first 100,000 that they got as a tax deduction now is recouped. And then anything over that initial 100,000 rand that they realize would be a capital gain. If, on the other hand, they hold that investment for the period of 5 years or longer, there's no recoupment anymore. But what happens then is that the full 250,000 that they realize eventually as proceeds is taxed as a capital gain. And because it's an individual, there's a 33.3% inclusion rate. Right? That's why they end up including 83,333 in taxable income eventually. 50,000 out of 150,000 in outcome 1 is included because of the 33.3. So hopefully that's going to help to popularize those VCCs. It'll be interesting to see what effect it does have. This change to Section 18 Cap A is a mixed bag. So one of the, sorry, just to set the scene, what we're talking about here is public benefit organizations that provide funding to other public benefit organizations. It's only those public benefit organizations that this amendment is concerned with. So for instance, you've got schools that are public benefit organizations. Most of those schools have set up trusts that do fundraising activities and provide funding to the school. So the school's a PBO, and the 9th schedule allows that trust to also register as a PBO if it provides funding to other PBOs. Now, one of the complaints with the current setup, which is that, let's say that the trust takes in 100 of donations in year 1, and it issues a receipt to the donor, allowing the donor to claim a Section 18A tax deduction for that 100 that they gave to the trust. Under the current law, what it says is that the trust has got to distribute or incur the obligation to distribute 75% of those receipted donation funds within 12 months of its year end. So it's got to take 75 of that 100 and distribute it, or incur the obligation to distribute it within 12 months after the end of the year. And it's seen that that is too onerous. The 75 is too high. So the complaint has been, well, these trusts can't really become sustainable because they keep having to get rid of the vast majority of their funds within this short period of time. So the first amendment is to say, fine, let's lower that distribution requirement from 75 to 50. So in our example, 50 of that 100 would have to be distributed within 12 months after the end of the year. Well, they've changed that as well. We'll get on to the period. So the 75% requirement, the last bullet there, says that that's going to be reduced to 50. But then the wording is the following. In respect of the retained amounts, that the PBO will have to distribute or incur the obligation to distribute all amounts received in respect of investment assets held by it, other than amounts received in respect of disposals of those investments to PBOs, every 5 years. So there's a 5-year requirement now, not after 12 months anymore. But it says that they will have to distribute or incur the obligation to distribute all amounts received in respect of investment assets held by it. Now, what's meant by all amounts received in respect of an investment asset? For instance, if that trust goes and buys shares and it sells the shares, what it gets as the proceeds from the disposal of the shares is an amount received in respect of the investment assets. It's not only talking about the incremental return that it gets. All amounts received. Okay, so in our example, it leads, and that interpretation, I think, is clear from those words in the brackets, because it specifically excludes other than amounts received in respect of disposals of those investments to PBO. So it's obviously looking at the capital amount if it's a disposal of the investment. So if that is then the interpretation, we take this example, well, let's say that they get 100 in year 1, and then let's say that they now take that 100 and they go and invest that amount into an investment. And that investment then grows. Let's say that they distributed 50 in year 1, the other 50 they're retaining, and that investment then grows. And then they go and dispose of that investment, let's say for 53. They then take that 53, they go and invest it into another investment which grows to 57. They dispose of the 57, they put it into another investment. All of those amounts, the 3 plus the 50 plus the 7 plus the 57, all of those amounts are amounts received in respect of investment assets held by it, which I don't think could have been the intention. I think it's just the increment, I think it's just maybe the final amount that's disposed of. If you roll it into something else, you shouldn't be taking all the transactions along the way into account, because there's a double counting. And if they don't distribute those amounts within the 5 years, they're going to be deemed to be taxable in the hands of the PBO. So a major problem that I see with this is in the record keeping. But firstly, there's no definition of investment asset. So it just talks about amounts received from investment assets with no definition. If the PBO goes and puts those amounts into a current banking account, and let's say there's no interest on the current banking account, is that current banking account an investment asset? Because if it's not an investment asset, then maybe that's the way of getting around this then, because they put it in that account, or some of it into that account, then it's not an investment asset, and they can then, they're not subject to this distribution requirement. So if you look at the word investment in the dictionary, it refers to putting money aside for purposes of deriving a profit or a gain. Okay, so if it's just holding the current value, then there's not a profit or a gain. But what's clear is this record keeping requirement, because now they're going to have to differentiate between funds that they get in for which donations were, for which receipts were issued, from other funds that they get in, because this distribution requirement only applies to receipted donation funding. So they're going to have to do this analysis, and I think that the best is actually to keep the assets separate. So in other words, the funding that they get in from, that they've issued receipts, to keep those investments ring-fenced into one side, as opposed to, for instance, trading receipts or other type of receipts that they didn't issue these Section 18A certificates in respect of. And then also the effective date, 1 March 2015, when this is brought in, seems to imply that on the 1st of March 2015, this analysis of what funding related to receipts and what have they done with that funding, what assets that they've got now related to receipted donations and which assets don't, will have to be undertaken so that they can comply in the future. So, I can see a huge compliance burden arising in the hands of these PBOs. But one of the interesting things is, even under the current wording, it says that they must distribute or incur the obligation to distribute within a prescribed period. So what stops them from, let's say, getting to the end of that 5-year period, just before that, saying, right, today we sit down and we resolve and we agree with the recipient that we will be distributing that amount in 10 years' time. And I mean, even under the current wording, that sort of interpretation is possible, although I'm sure SARS wouldn't be very happy with it. Okay, turning to the Employment Tax Incentive Act. The major problem that's been addressed here, or it's perceived that it's a problem, is that if you've got someone who works for less than your sort of standard 160 hours in a month, let's say that they permanently work for 80 hours in a month, should one then get the same employment tax incentive for that person as for someone who does work 160 hours a month? Because the way the current provisions are worded, it talks about if a person works for less than a full month. But now what's meant by working for less than a full month? What exactly is a full month? I mean, if you permanently work for 80 hours and not 160 hours, there's an argument that you did work for what for you is a normal full month. So the idea here is that that sort of argument is being taken away, and the amount of the incentive is going to be determined with reference to a baseline 160 hours. Now, unfortunately, the proposals here have been badly drafted. There are some glitches in them. What I'm giving you is my interpretation of them, which is what I got from the explanatory memorandum, and I think that you can read in kind of that is what should apply, but there certainly are some gremlins that have crept in with the bill. If the employee is employed for more than 160 hours a month, then no complications arise. You simply read off the amount, you calculate the amount of the incentive as normal, and that's the incentive. It's where they work for less than 160 hours a month. what you're then going to have to do is gross up the remuneration to determine what the amount is on the band in the Employment Tax Incentive Act for that amount of remuneration in a month, and then gross the incentive down based on the number of hours that they actually worked. So you gross the remuneration up to read the amount off the band, and then you gross the incentive down. Coming in 1 March 2015. Just thought let's have a look at some of the examples, or some examples, to see how it seems that it should be applied. So we've got Sifiso working for Company A for the full month of November, and he works for 120 hours. He earns 3,000. So he worked for less than 160 hours. So to determine the band, you take 160 over 120, you multiply it by his remuneration as defined in the 4th schedule. You get to 4,000 Rand. So you read off now, how much would the incentive be if a person got 4,000 Rand a month? So that is 1,000 Rand, the incentive. Then you gross the incentive down by the number of hours that they actually worked. Exactly the same situation if he resigned halfway during the month. Exactly the same principles, because under the wording here, it doesn't actually matter. As long as a person worked for less than 160 hours, whatever the reason, you do this grossing up and grossing down. So the same principles exactly apply in that situation. If he works for more than 160 hours, say 170 hours, and he earns 5,000, it's very straightforward. You just determine it as normal. So the actual remuneration determines the wage band, and unfortunately you don't gross the incentive up by 170 over 160. That just remains what it is. So that's, I think, the major change. It's also been said that there'd be a credit refund mechanism if people are in a credit for the employment tax incentive. Now, the way you could be in a credit, I think wouldn't happen very often, or not to a lot of companies anyway, because what it means, remember that the way you do this incentive, or the way the incentive works, is whatever the incentive is, you subtract from the pay as you earn that the company's got to pay over every month. So you could be in a credit if you, let's say, had 1 or 2 employees who presumably then don't earn very much, so there's not that much pay as you earn, and then a whole lot of employees who get the incentive. So the incentive wipes out the pay as you earn liability. But the idea being, at the moment, people are carrying forward these credits, awaiting a refund mechanism, which is supposed to have come into, or supposed to come in the 4th quarter of this year. Well, we're nearly at the end of the 4th quarter of the year, and it's not come in yet. But the problem that's been rectified here is that it says that if you, at the end of your EMP 501 period, is when you would claim these refund credits. In other words, 1 March and 1 September. If you've got credits 1 March and 1 September, then you can claim them provided that you're tax compliant. The way it's worded is that if you're not tax compliant on 1 March and 1 September, you've got to wait until the next 6-month cycle to be able to claim the amount, even if you become compliant in the meantime. So now the change is, if you become compliant in the meantime, you can claim the incentive once you become compliant. Also, just to mention that at the moment, there's a 6,000 Rand per employee limit that you can carry forward from one EMP 501 period to another under the incentive. That 6,000 Rand limit has been done away with. So also just to take note of that. The Special Economic Zone incentive has come in for quite a bit of amendment. I'm not going to plough my way through that. Although the Act has been gazetted, it's not in effect yet. But just to show you what those benefits actually are, I've put them up here. So this is what's up for grabs if you operate within a special economic zone. An accelerated building regime for new and unused buildings where you could write them off over 10 years. VAT and customs relief similar to the current IDZ setup, where those zones are kind of regarded as VAT and customs free zones. A 15% corporate income tax rate. Employment tax incentive applicable regardless of age, but the employees must still be earning less than 6,000 Rand a month to claim it. And I must also add in the Section 12 capital I, the industrial policy project incentive that we looked at just now, where you could claim additional allowances up to 100% for manufacturing assets and your training allowance. There's you get to the 100% rate there if, for instance, you operate within an SEZ. They're beneficial rates if you're in an SEZ. But that 12I only applies to manufacturers. What I did find useful in the explanatory memorandum is this decision tree, which just shows in which circumstances a company might be eligible for what incentive of the ones that are listed there. So I've given that in the slides from the EM. I'm not going to work through that. Moving now to international tax. If anyone is involved in Section 9D, controlled foreign company calculations, and there's a foreign business establishment involved, then you'll be relieved to know that probably a lot of your admin burden will be taken away, because one of the problems is we've got two main exclusions in 9D. One is if the controlled foreign company pays at least 75% of the South African income tax that would have been payable on the income if it had been resident in South Africa, then the income is null. So that's the high tax exclusion if 75% or more foreign tax is paid compared to what SA tax would have been. So that one you hit quite early on into 9D, 9D2A. Then 9D9 contains an exclusion if you've got a foreign business enterprise in an outside jurisdiction, and the income is attributable to that. Now the problem is that that calculation to determine whether the foreign tax is at least 75% of SA tax is often a very onerous calculation, especially where there's a foreign business establishment. It can get very complicated. But because 2A comes before 9, you've kind of got to do this long calculation, even if you know ultimately that all of the income is going to be excluded because it attaches to a foreign business establishment. So it's simply been made now that the net income of a CFC will be deemed to be null if either the high taxed exemption applies, or if all, but then just note it's got to be all, of the receipts and accruals of the CFC are attributable to the foreign business establishment and the anti-diversionary rules don't apply. So that's a welcome amendment to Section 9D. Transfer pricing. This is also a welcome amendment. At present, what happens is, if there's a transfer pricing adjustment, so let's say that you've got a foreign holding company that supplies goods or services to a South African subsidiary, and it overcharges for those goods or services. Right? So the South African subsidiary is claiming too much of a deduction. Let's say it should have charged 600, it actually charges 1,000. So you've got 400 too much of a deduction. That 400 you've got to add back in the South African calculation as a transfer pricing, what's called a primary adjustment. But then there's also a secondary adjustment, and what the section says is that that 400 is deemed to be a loan that constitutes an affected transaction. So in other words, you then deem to have made a 400 loan to the holding company. The idea being that interest on that 400 must itself be added in to the calculation of taxable income. So it's the primary adjustment plus interest that gets added back in the South African calculation. But the problem is really that how do you get rid of a deemed loan? Because once the Act deems that to be a loan, it's not an actual loan. So how can you repay a fictional loan? How can it ever be repaid? And the thing is that even, long after that, that holding company may no longer even be the holding company in relation to the subsidiary anymore, but that deemed loan continues forever and a day. So there's been a lot of complaint about the secondary adjustment. And the good news is that we're going back to essentially what happened under STC. If you think back to STC, if you had a transfer pricing adjustment, that adjustment is deemed to be a dividend for STC purposes. This is what we're going back to now. So it's going to be deemed that a primary adjustment constitutes a dividend in specie, declared and paid by the South African party to the non-resident party. Where the transactions between a resident and a non-resident, or between a resident and another resident, basically, in other words, where the transaction results in an erosion of the South African dividends tax base. That's the idea. If the South African party is not a company, in other words, it can't declare a dividend if it's an individual, for instance, that's got this transfer pricing adjustment, it's then deemed to be a donation for donations purposes. So you'd have 20% donations tax applicable on the primary adjustment. The deemed dividend is deemed to be made 6 months after the end of the relevant year, and note that that is the year in which the transaction occurred. It's not the year in which SARS comes back and finds out about it and makes an adjustment. It's the year in which the transaction occurred that one's got to pay the dividends tax. The effective date of this is 1 January 2015. So if we just look at a few examples. So we've got a foreign company that pays 65 million for goods provided by the South African subsidiary, and the South African subsidiary in this example undercharged for those goods. So in other words, there's too little income being recognized in South Africa. That 35 million adjustment is now going to be deemed to be a dividend in specie paid by the South African sub to its foreign parent. Example 2. This is a similar idea to example 1, but in this case we've got a foreign sister company, not a holding company. So foreign sister company grants a 10 million loan to the taxpayer. Foreign sister company charges too much interest, so we're claiming too much interest in South Africa. South African company claims an interest deduction of 100,000, it should have actually been 60,000. So SARS affects a primary adjustment in terms of Section 31, whereby interest is now cut down to 60. That 40,000 differential is deemed to be a dividend in specie, declared to the sister company. So note, it doesn't have to be that it's a shareholder that's the other party involved. It actually doesn't matter as long as it's a connected person and it's a South African resident on this side getting the benefit. Now here's something that one's got to be careful of. What are they doing about pre-existing deemed loans? What they're doing is that on 1st of January 2015 it's being deemed to be a dividend in specie declared on that date, to clear these things, get rid of them. Now, I thought let's just look at this example as to how this would work. So we've got company A's year ends on 31 August. Let's say that during 2013 there was an adjustment made, because just bearing in mind that this deemed loan provision that we've got at the moment actually kicked in from, it was years of assessment after April 2012, starting after April 2012. So the 2013 year could have been the first year that we had these loans. So interest of $1 million accrued to its UK resident holding company, and it should have only been 600,000 of interest. And just to make it a little bit easier, I said, let's assume that they rectified that in 2014, so we didn't land up with two lots of deemed loans, one for 2013 and another loan in 2014, just to simplify it a little bit. So we've got this deemed loan that arose in 2013, and it's been going all along. So the first thing is that we've got the primary adjustment of 400,000 in respect of that 400,000 adjustment. And so interest on that loan would have to annually be included as a secondary adjustment. And let's say that that was 80,000 in 2013, 90,000 in 2014, and 30,000 up to 31 December 2014. Now, one of the things that's not totally clear is whether one's got to calculate when that deemed loan is deemed to be declared on 1 January, if you've got to compound interest and include it in that amount that's deemed to be declared. In my view, the correct interpretation is that you do, because it's deemed to be a loan that constitutes an affected transaction, in other words, on which no interest was charged, but if you had charged a market-related rate of interest, in most normal commercial arrangements, interest would compound on such a loan, if the interest isn't actually being paid on that fictional loan. What I do think, with a fair degree of certainty, is that you can't use a double tax agreement to reduce the 15% rate. It's going to be 15 for everyone on these transfer pricing adjustments. Okay, because in the absence of this adjustment, it would have actually not been a transaction at all. It's deeming it to be a dividend. So in other words, dividends tax of 15% of the 600,000, in other words, 90,000 must be paid by the end of February on that deemed loan. So calculating these amounts, if you do have any of these adjustments, please come and chat to us, because one doesn't want to get this calculation wrong. I'm not going to spend much time on this amendment here about Section 9H. It relates to the capital gains tax exit charge, as it's called, that where a person is no longer a South African tax resident, they deemed to have disposed of all of their assets and reacquired them, excluding property in South Africa and permanent establishment assets. What's not clear at present is what the currency of disposal is and the currency of reacquisition of those assets. And it's just been made clear that it's the currency in which you acquired those assets. That will be the same currency that you deem to have disposed, in which you deem to have disposed of them. So I've got an example there which, if you're in that situation or you're concerned about it, also it applies where a controlled foreign company ceases to be a CFC. You'd also have that deemed disposal. As I mentioned earlier, the withholding tax on interest, that's been put off to 1 March 2015, interest that is paid or that becomes due and payable on or after. But as I mentioned, 23M is that date hasn't been made to coincide with 1 March 2015. So we've got 23M for 2 months before we hit the withholding tax on interest. So that's a bit of a glitch.
Sorry, David.
Sure.
You mentioned earlier something about the withholding tax if it's zero on the interest, it doesn't come into play in 23M. Why don't you just elaborate, please?
Okay. Yeah, the question is, with the withholding tax, when 23M will apply, when the withholding tax on interest will apply. The withholding tax, Section 23M says that it applies if the creditor is not subject to tax in South Africa on the interest. So a question that's been debated, there's still some disagreement, but I think the majority of commentators are of the view that what that means is that if there's no level of tax paid in South Africa on the interest, so in other words, if you have, as most of our, with the major trading partners, our double tax agreements reduce the withholding rate to 0, that would be a trigger for 23M. But if the withholding rate is 5% or 10% or anything for that matter, then 23M won't apply to that interest.
Do you think SARS will clarify that? Because is there not an argument to say that there is tax, it's just at 0%?
Yeah, I mean, that has been the debate. That has been the view of some people that, that there is, it is subject to tax because it's gross income, even if it's exempt. I mean, that's been the argument. I don't think that's what was intended, and I think that SARS's view is what I've given now. I haven't seen any sort of formal clarification given. But I was at a meeting with various, there was a National Treasury feedback session, and this issue was raised informally, and it seemed that most people, espoused the same view that I've given here. Looking at VAT, I just selected two of the amendments there. The first one I think we can be relieved about, and that they were going to take away the 0 rating for goods used for agricultural purposes, which fortunately that's now been delayed, if not put off altogether. They said it's been withdrawn for at least a year. One would think that would have direct consequences for the cost of food. So hopefully that's going to stay away, I think, from the point of view of most consumers anyway. But there is felt that there's quite a lot of abuse of the system going on in this area. Good news for importers of goods. It's probably easiest to see what the effect of this is if we look at an example. So let's say we've got a company with a 2-month VAT period, and let's say that VAT period that we're looking at here ended 30 June 2014. They imported goods into South Africa during that VAT period, June 2014. And customs cleared the goods in June, but the importation agent only paid the VAT, on importation during the month of July. Now, from the 1st of April 2014, Section 16.3 was amended to say that before you could claim back the input on the importation, the VAT had to actually be paid over first. So currently the way it works is that you'd have to wait now till the end of your August VAT period to be able to claim that back, because the VAT was actually only paid during the month of July. So the good news is that we're going to go back to the situation that applied before April 2014, which is that as long as the goods have been cleared by customs, you'll be able to claim back the VAT even if it hasn't been physically paid over to SARS yet. It's just a year later, so we had this 1 year in the middle. Then just picking a few things up from the Tax Administration Laws Amendment Bill, and there are actually quite a number of amendments in here, especially with provisional taxpayers. The first one being that provisional taxpayers 65 years and older are currently exempt from provisional tax. There's a specific exemption provision 18(1)(d) that applies to them, and I've set that out there that if their taxable income doesn't exceed 120,000, doesn't come from business in any measure, and only comes from those types of passive income, remuneration, interest, foreign dividends, or rental of fixed property, then they are exempt from the payment of provisional tax. Now that is going to be deleted, and we're going to in future have, regardless of age, this paragraph that is currently already in the Act applying to everyone. So in these passive income type circumstances, you'd go to para 18(1)(c), and it says if you're a natural person, you don't get income from a business, and one of two things: either the taxable income doesn't exceed the threshold, or then the taxable income which is derived from interest, foreign dividends, and rental, at current it says will not exceed 20,000 Rand. The 20 is being moved up to 30, and then this is now going to be where everyone will go to for this exemption. the thinking actually is that, do we need one for people over the age of 65? Because if you look at this one, it talks about the tax threshold. The tax threshold for people who are over the age of 65 is 110,000 Rand, actually. It's close to 120 anyway. It's 110. And then if you're over 75, it's 123,000. So it's even more than 120. So that's really the thinking behind the deletion. But this will now apply years of assessment commencing on or after 1 March 2015. So it would apply, to the first period of 2016 for those individuals. The definition of basic amount, the basic amount is what you use. I'm sure most of you provisional taxpayers know. It's the taxable income from the year most recently assessed. That's the main category. And where it comes in is if you are making your first provisional payment, then usually you've got to at least use the basic amount, otherwise SARS queries it. And if you're under R1 million of taxable income, then you can use the basic amount as a sort of safe harbor without a penalty, under estimate penalty. And the proposal is that paragraph D, lump sums, are going to be excluded from the basic amount because of their kind of one-off unusual nature. So you won't have to, if you had a para D lump sum in the most recently assessed year, that doesn't become part of your basic amount now in this year when you're making your estimate. Then the proviso to para 19(1)(e)(2) will be deleted. And basically what that proviso says is that if you get an IRP6 form relating to the payment that you're going to be making, issued by SARS, that IRP6 form, that you can use the estimate of taxable income in that form with scale up if necessary at your choice when you make your first provisional payment. If you've got that form printed out, you don't necessarily have to use the year most recently assessed when you actually make the payment. Now that's been taken away. So let's just look at this example. We've got Mark Williams about to submit his estimate for the first period of 2015. On the 1st of May, his latest year assessed is 2013, and taxable income for that year was 650,000. And because he knows that 2014 has recently been submitted and it's about to be assessed, he quickly goes and prints out an IRP6 form because he knows 2014 is quite a lot more and he doesn't want to have to make a bigger payment than necessary. So he now obtains an IRP6 return for the first period 2015 with an estimate based on 2013 with your 8% per annum, 16% in total in our example, scale up because there are 2 years of assessment involved. He's aware that his taxable income for 2014 is higher than the 2013, and that's why he gets that form printed out when he does. If Mark pays his provisional tax on 31 August, then the proviso now allows him to base his payment on the taxable income in any provisional tax return issued by the Commissioner. So he's allowed to use his 2013 estimate even though 2014 was subsequently assessed. What the deletion of the proviso means is that when taxpayers now make their provisional payment, the estimate of the basic amount must be based on the taxable income from the year of assessment preceding the year in respect of which the estimate is made. Okay, so you would now have to, in this example, use 2014 and not 2013. And this is provided that the assessment was issued at least 14 days before the taxpayer submits his estimate. Okay, if it's within that 14-day period before you submitted it, the idea is then you can use the previous year with the scale-up. Okay, then it won't apply to you. Well, you've then got to use the latest year if it's within that 14-day window period.
So David,
yes.
to be clear, if you submit your provisional tax form very early,
Yeah.
obviously before the assessment comes back,
Yes.
then you also say,
Yeah, Tennis, that's an interesting point. If in our example, what happened here is that Mark Williams made the payment and submitted the form on the due date, on the 31st of August. Interestingly, the way it's worded is that if he'd actually, on the date he got that printout of the IRP6 form, if he'd actually submitted it on that date, he would still have been able to use 2013 on that date. And even now with this amendment, that's still going to be the case.
even if they only paid it later, but submitted before.
I'd have to think about that one. Sorry, I didn't really consider that, but yeah. I'll have a look at that afterwards.
I'm just looking to save some clients.
So this change will now come in years of assessment commencing on or after 1 March 2015, i.e., the first period of 2016 would start to be affected by this deletion. Then quite a lot of changes to the provisional tax penalty regime. Starting with this para 20 cap A penalty, which is a nightmare and it's been deleted, but it's still going to be a bit of a nightmare even with the deletion. Because when you first look at this, you think, hey, they're getting rid of para 20A, but there's a sting in the tail, like there is often. What para 20A levies is a penalty for the late submission of the second provisional return, not the first, the second, for a year. If you submit the form late, right, as opposed to paying it late, if you submit the form late, you're subject to a 20% penalty. So that's being repealed. But really the reason why it's being repealed is that if you have a look at some of the other amendments, what they're doing is that the para 20 penalty, which levies also a 20% penalty if you underestimate your second provisional payment. The change, or one of the changes there, is that if you don't submit your estimate at all, it's going to be deemed to be a null submission for the purpose of that provision. Okay, so that's, so you're still going to be saddled with the 20% penalty. A thing that is positive is that para 20 levies, as I said, this 20% penalty for underestimation of the second. There's also para 27 that levies a 10% late payment penalty for any provisional tax that's paid late. And the idea being that if there's a double jeopardy type of situation where 27 and 20 both apply, that 27 is going to be applied first, and then the para 20 penalty will be reduced by the para 27 late payment 10% penalty. And then it's proposed that the non-submission, as I said, of the second provisional return is deemed to be a null estimate for the purpose of the para 20 penalty. But the Commissioner has also been given the power to remit the whole or part of a penalty imposed for the failure to submit the estimate timeously if satisfied that the failure was not due to an intent to evade or postpone the payment. So that's been added in. Because one of the questions when you look at this new amendment to para 20, it just says if there's a failure to submit the second provisional return, then there's this null estimate. It doesn't say by when you must have failed to submit. Now it can be read in, and I think maybe because of the wording of that blue highlighted part, it should be read in that it's a non-timeous submission. Because why does it then use the word timeously in the Commissioner's discretion? So I think the idea is that if you don't submit it by the due date, they can levy this 20% and deem it to be a null submission.
David?
Yes.
Couldn't you then, if you realize that you underestimated your second provisional payment, go and request a correction on your provisional payment, submit a new second one, which the system would allow you, and then rather pay 10% on your underpayment because you're paying late? and then in that way you would avoid that 20% for underestimation.
Yes, so in other words, what you would do is do a correction after. So what you're saying is that if you'd paid late,
You submit it on time.
you submit it on time,
you
yes.
submit it on time and you pay on time.
You pay on time.
If you afterwards realize that you made an error when you estimated it and you underestimated it would leave you in a 20% penalty, then nothing stops you to request a correction of that second provisional return, resubmit it, and rather just pay 10% penalty on late payment.
Yeah, I'm not so sure that if you underestimate your first one, the first time round, if that couldn't be taken to then be an underestimation. I know that the system does, allow you to actually resubmit those things, but maybe with this amendment coming in now, that the first one would be taken to be your underestimate, even though you make a so-called correction afterwards. So you didn't make the correction on the due date, therefore it's, that there's still an underestimate of the first. I think that argument is probably open to SARS, but my understanding is that they don't apply that at the moment. That's not the way that the system sort of set up. Then just a few other taxpayer-friendly corrections, these ones, and the one is that normal tax. The Para 20 penalty is based on the term normal tax, and that is actually before the rebate. So you're faced with this penalty, which is before you take the rebate off. It's 20% of normal tax. So that rebate's going to be allowed to be taken off. In addition, Para D lump sum amounts are going to be excluded from the calculation of the 20% penalty. I think that's a good amendment, because if you think about it, that penalty is based on, if you look at that red writing, the top bullet there, the difference between normal tax and the sum of employees' tax and provisional tax. Now, in a Para D lump sum, your employer should have paid over the employees' tax. And if they haven't, it's not your fault. Why should you be then faced with that penalty, which doesn't take into account employees' tax paid by the due date? So this is effective 1 March 2014. So these changes will come in for the second provisional payment now of 2015 year. But what's quite interesting is this blue highlighted part giving the Commissioner the discretion to remit that penalty. That's been made a year later. I'm not sure why that is. That's years of assessment commencing on or after 1 March 2015 only. So, the way it's worded is the Commissioner can't exercise that discretion for this period, but then only for the next year, which I presume is an error. Just looking at this example, let's say we've got Sue Makaza, age 50, taxable income for 2015 of 1.5 million. She didn't submit her second provisional return or make a payment. She made a first provisional payment of 120 and employees' tax was 220. And the failure to submit her second provisional return would then result in a deemed null submission. The 20% penalty, I've set out the formula there, and I then calculated it based on the normal tax after rebates on 80% of 1.5 million, so that the amount that should have been paid is that 53,246, and the 20% of that gives you 10,649. Because it was paid late, there's a 10% penalty of the amount that wasn't paid on time. So that's 10% of 53,246. And that amount, in terms of the Tax Administration Act, can be reduced. It can be reduced by 2,000. And if exceptional circumstances, such as crowd violence, Eskom shutting down permanently, pestilence, rinderpest, and various other things are met. But they've really got to be exceptional circumstances. The Commissioner can remit them all together. But the point is that whatever that Para 27 late payment penalty ends up being, goes to then reduce the para 20 penalty. And I just thought this is actually very important, you know, reportable arrangements. The penalties, if you don't report a reportable arrangement, are, to say the least, prohibitive. Minimum penalty is 100,000 Rand a month. It goes up to 300,000 Rand a month. It just depends on the size of the arrangement. And at present, the participants only need to report it if there's no promoter. Promoter is a person who says principally responsible for designing it, marketing it, and so putting the arrangement together. So if there isn't such a person, or if that person is non-resident, then all of the participants have got to report it. It's now going to become that all participants need to report it, whether or not there's a promoter or the promoter is non-resident. And included in the definition of participant is a promoter. So the promoter will also have the responsibility to report it. You don't need to report it if you've got a written statement from someone else in the arrangement that they have already reported it. And this is quite alarming, and it's very important to watch the developments in this space. But SARS earlier this year released a draft list of arrangements which they wanted to make reportable arrangements. And it was released for public comment. But what's alarming about this list is just how commonplace these sort of transactions actually are. The payment of fees by a resident to a non-resident in respect of services rendered to the resident in the Republic, which exceed or are expected to exceed 5 million Rand. They would become then a reportable arrangement. Now, what's not clear from this, there's an ambiguity in there, because it talks about in respect of services rendered to the resident in the Republic. Now, what's in the Republic? Is it the resident that must be in the Republic, or is it the rendering of the services that must be in the Republic? And I think that probably what's intended is that the rendering of the services is what must be in the Republic. So then, I mean, if you've got, let's say, a non-resident holding company and it charges management fees to a South African sub, and it does all the work outside the Republic for those management fees, you can then say, well, the services weren't rendered in the Republic because all of the work was done outside the Republic. But another interesting twist on this is it doesn't use the word source in the Republic. It says the services were rendered in the Republic, but the source rule for services is where the services, where you do the work that gives rise to the earning of the income. So in other words, where the UK holding company actually did the work would govern the source of the income. So that's where the services presumably are rendered, but it's a bit ambiguous to say the least. Then the buyback by a company of its shares for an amount of 10 million or more, if the company issues or is required to issue shares within 12 months of entering into that arrangement or the buyback. Now, these type of arrangements are often used if you've got a company that holds shares in another company. It's a way of getting that first company holding the shares can then dispose of its shares without paying capital gains tax or dividends tax if you enter into that sort of arrangement. So maybe that's why they've included that there, because they want an early warning system for those type of arrangements. But what they do about them, I don't know. You know, you report it as one thing. It doesn't necessarily mean that it's necessarily an impermissible arrangement for GAR or anything like that. An arrangement expected to give rise to rebates for foreign tax exceeding 5 million Rand. I mean, that's not a lot of money. So if you get foreign tax credits or rebates, 5 million Rand now becomes a reportable arrangement. Contributions by a resident to a non-resident trust in terms of which the resident acquires a beneficial interest in the trust and the amount is 10 million Rand. If you acquire a controlling interest in a company with an assessed loss of 20 million rand or more. Reportable arrangement. And then the payment of an amount exceeding or likely to exceed 5 million by a resident to a non-resident insurer, if amounts to be payable to beneficiaries are determined mainly by reference to the value of particular assets or categories of assets held by the insurer or any other person. Now, I must repeat, these are not reportable arrangements at the moment. This is a draft list that was issued for public comment. It hasn't been made final. But what is concerning is just the sort of thinking of SARS, and it's going to be very important to monitor the space for when this list does become final, to avoid these penalties. Just one or two other TAA amendments. One of them is that the definition of relevant material, which SARS can then request when they're doing an audit, for instance, is now going to become determined by SARS. What constitutes that? It's no longer going to be an objective test. It's up to SARS to determine what they believe is relevant material. So one of the things that there's an argument at least that's not relevant material is a tax opinion that a client has. Tax opinion, because it's argued that it's not relevant to SARS because SARS has got to make its own mind up about the tax consequences of an arrangement. It mustn't be up to the private sector to tell SARS what the tax consequences are. SARS should make its own mind up about that. Now, if this becomes in the opinion of SARS, then maybe SARS will take the view, well, sorry, that is relevant and you must give it to us. Then the definition of return is also going to include the submission of relevant material. So I think the thinking here is, at the moment, there are administrative non-compliance penalties levied in terms of the Tax Administration Act. But those penalties haven't been switched on yet for non-individuals. So for companies, trusts, those penalties, that table doesn't apply, those monthly penalties. Only applies to individuals at the moment. But in future, when it is switched on, if SARS then requests relevant material and you don't submit it by due date, you can then be subject to these administrative non-compliance penalties. And then there have been a number of tax cases this year, but a lot of them concern the Tax Administration Act, and I just thought in closing that we could just look at this one. And it's quite fitting maybe that we are in Pretoria East. I don't know if anyone knows this company, Pretoria East Motors. Anyway, what's of relevance here isn't so much the facts of this case, because there were a whole lot of issues in dispute. There were 13 or 14 issues in dispute, VAT dispute as well as income tax disputes. What really is of relevance is that the Supreme Court of Appeal criticized SARS's conduct of the audit of the taxpayer, because what this representative of SARS did in the audit was that if they didn't understand something or the reason why the taxpayer had treated something in a particular way, they simply added it back, issued an assessment, and added on a 200% penalty, leaving then the taxpayer to argue the toss in the tax court. And the Supreme Court said SARS shouldn't do that. They've actually got to properly engage the taxpayer. They've got to have proper grounds for the raising of an assessment. They can't just raise an assessment if they don't understand something and then leave it up to the taxpayer to fight it out in the tax court. And they said that in that way administrative justice would be served if the taxpayer is made aware of the issues so that they can properly respond, and in that way then engage with SARS to sort the issues out. Also, the taxpayer's explanations have got to be given proper weight by SARS. They can't just dismiss them and wait for the matter to get to the court. Right, thanks very much for attending this morning. That's the end of the presentation. If there are any questions that you have, I'd be happy to chat to you. I think maybe we've sat for quite long, so Maybe it's best if you come and speak to me afterwards if there's anything you'd like to discuss further. But thanks very much for attending once again, and hope to see you next time. I want to say next year, but I'm sure we'll have various tax updates in the meantime. Okay, thank you.